Welcome, Appalachian State University. I will start time as soon as a member of your team begins speaking. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Hello, my name is Sean and I am joined by Obi, Olivia, Sam, and Zach from Appalachian State University. We are presenting a sell recommendation for the Albemarle Corporation with a target price of $95.50, representing a 37% downside from Friday's closing price. We believe ALB is a sell because its business mix and contract structure will prevent superior profitability. Also, its balance sheet strategy to fund capacity conflicts with maximizing shareholder wealth. And finally, Albemarle is not the environmentally friendly pure lithium play that investors think it is. Albemarle is a specialty chemicals company that operates in 3 distinct industries. It holds revenue and capacity leadership in the lithium and bromine industries and operates in a niche marketing environment in the catalyst industry due to the customizable nature of a catalyst unit. The bromine and catalyst segments acts as a hedge when the price of lithium is low, but prevents the company from recognizing superior gains when the price of lithium rises. For example, let's take a look at Livent, a pure lithium competitor. In 2018, when the price of lithium was high, Livent's gross profit margin was 10 percentage points higher than Albemarle's. Unfortunately, Albemarle's diversified business mix will hurt its success as the price of lithium rises. We also believe that the company's long-term contract structure will prevent superior profitability. Currently, 90% of Albemarle's total lithium volume is contracted. Rising prices puts the company at a disadvantage relative to competitors who rely solely on the spot price. We also expect Albemarle to recognize a lower selling price in 2021 than in 2020 due to customers renegotiating contracts. However, even if we assume that Albemarle can sell lithium at a 10% premium to the spot price throughout our forecast, our sell recommendation still holds.
While Albemarle's mature segments act as cash cows, providing much-needed funding to the lithium segment, the company's capital expenditures have exceeded its cash from operations since 2017. This means the company must continue raising capital to fund its plans for additional capacity. However, Albemarle's credit agreement restricts its debt to EBITDA to 3.5 after 2021. The company is currently above this threshold, and we anticipate Albemarle will delever throughout 2025 in order to remain in compliance with its agreement and improve its credit rating. Yet, even if we maximize Albemarle's debt to EBITDA and directed all funds toward CapEx, significantly growing lithium unit volume, our sell recommendation still holds.
Conversely, Albemarle can issue new shares, but this comes in conflict with maximizing shareholder wealth. When the company issued $1.3 billion in common stock, it caused more than just dilution. It raised our cost of capital to 11.1%. Our forecasts now show the return on invested capital never coming close to the weighted average cost of capital, even assuming that lithium demand will grow at a 43% CAGR. We used a benchmark of 2% above and below the WACC to distinguish value creation from destruction. Unless the price of lithium increases to $34,000 per metric ton, a price point we believe is unsustainable, Albemarle will destroy value to grow lithium.
We utilized the scores of multiple third-party ESG data providers to compare Albemarle's ratings to its competitors. Despite seeming like an inherently good ESG company, playing a key role in EV adoption, Albemarle has shortcomings that aren't reflected in its ratings. The company scores 3 out of 6 on the entrenchment index, which is worse than the average of 2.4. This is indicative of circumstances that bolster the board's power at the expense of shareholder rights. Albemarle's high social rating is driven by perfect community and human rights grades, but Albemarle's social rating fails to reflect the impact that the company has in the communities in which it operates. In Chile, Albemarle extracts lithium from a salt flat in the driest desert on the planet. Lithium production uses over half of the water in the region, which has forced indigenous people from ancestral land. Chilean regulators are currently reviewing how water is allocated, which could cause Albemarle's expansion plans to evaporate. The production of lithium in Australia is not without its own environmental challenges. Hard rock extraction yields tailings, which contain harmful chemicals. Albemarle transports these tailings 500 kilometers into Australia's interior, which has sparked protests in the affected region. While EV adoption is an important element of mitigating climate change, an electric vehicle charged from energy produced by coal actually nets more emissions throughout its life cycle than a traditional vehicle. The world currently relies on fossil fuels for over 80% of all energy generated. And until EVs are powered on grids fueled by renewable energy, their environmental benefits will be diminished.
While insiders and institutional investors appear bearish on the company, we believe that retail investors view Albemarle as a pure lithium play and are charging up the stock price in expectation of an EV boom. In the past 3 months, commenters on the company's Yahoo Finance discussion board mentioned 3 positive words for every 1 negative word. The bromine and catalyst segments were hardly mentioned, while the lithium segment was mentioned 89 times. We believe that this textual analysis, combined with increased volume on Robinhood, supports that retail investors are trading with enthusiasm for the lithium segment. Our valuation, however, does not support this level of enthusiasm.
We arrived at our target price using 3 multiple-based valuation methodologies and a discounted cash flow. We considered 14 competitors across the 3 industries Albemarle operates in. However, we ultimately chose 1 clear comparable for each of its segments. For lithium, we utilized Livent, a US-based lithium pure play with similar South American brine operations. For bromine, we identified Israel Chemicals, and for catalysts, W.R. Grace. We derived our forward multiples by averaging these companies' historicals weighted to each comparable segment's percentage of total revenue. This methodology yielded a 24 times PE and a 12 times EV to EBITDA. Multiples on the high end of Albemarle's historical range are justified by our growth expectations for lithium. However, they do not justify how investors are currently valuing the stock. In order to more directly account for Albemarle's business mix, we valued the company using a sum of the parts approach with EV to revenue multiples. We priced lithium at 8.5 times revenue, higher than Livent's historicals due to Albemarle's superior market share and ability to fund growth with its other 2 segments. We value bromine and catalyst consistently with industry averages. Our sum of the parts analysis yielded an implied total EV to revenue of 4.2 times above all of Albemarle's historicals due to our high lithium multiple. Even when we price lithium so high that it is 78% of the value of the business, we still cannot justify a buy. Our 4th valuation methodology is a discounted cash flow. While we grow unlevered cash from operations at 19% for the first 5 years of our forecast, significant capital expenditures forecasted based off of Albemarle's capacity expansion plans will negatively impact free cash flow. Our 11.1% WACC is heavily dependent on Albemarle's cost of equity due to its premium equity valuation. Our 2021 intrinsic value estimate supports our relative valuations.
Our final target price of $95.50 represents a significant downside from last Friday's closing price. We compared our valuation to that of other analysts and found in the last 2 quarters of 2020, they raised their target prices by nearly 70%, despite no changes in earnings expectations for 2021. Instead, analysts inflated their forward PE multiples. We're confident in our estimation of fair value, and it does not support those multiples. We tested the sensitivity of our target price by stressing the major assumptions in our forecast with a Monte Carlo simulation. This indicated a sell 98% of the time. We found that our target price was most sensitive to our lithium unit and price assumptions. However, even if we assume a 73% CAGR in unit volume, our sell recommendation still holds.
We also considered several other risks. New methods of lithium extraction have generated buzz in the industry, but with experts stressing the primitive nature of this technology, we believe the industry's optimism is premature. If lithium extraction is the buzz, then sentiment surrounding mainstream EV adoption is the whole beehive. However, we believe overly eager investors will get stung as EVs continue to be plagued by weakened consumer confidence, driven by a time-consuming charging process and costs that the average consumer cannot justify, areas which the new infrastructure bill fails to adequately address. There's also a risk that Albemarle will seek additional expansion, but without direct assistance, we believe this to be highly unlikely due to the company's funding constraints. With a $95.50 year-end target price, we recommend a sell for Albemarle due to its business mix and contracts limiting profitability, its balance sheet working against shareholders, and the mischaracterizations of the company. Thank you. We will now open the Zoom for questions.
Thank you. Judges, at this time, please turn on your video. I will start time as soon as the judge asks the first question. Time will end at 10 minutes. Please feel free to begin.
Hi, team, and thank you for your presentation. I just have a question on the ESG grade, and the sector is not helping, but technically you're saying ESG grade is not good. Have you thought of any measures or actions the company is taking to mitigate this? I've recently read that they joined the UN Global Impact membership to mitigate and develop responsible business practices. So have you taken that into consideration in your valuation?
Yeah, absolutely. The company has made a lot of progress in recent years to target some certain initiatives like that. But in their most recent sustainability report, they talk about how these issues are important, that they're doing things about it, but they don't establish any goals that they're trying to accomplish. They just explain measures that they're taking. And keep in mind, Albemarle is a leader in two of the segments in which it operates. So inherently, they should have an advantage to take on these initiatives and be able to handle the expense of additional disclosure. And unfortunately, compared to some of their competitors and their size premium, they kind of underperform in that issue. And these issues have been around for decades. So actions in the last 2 years, they're definitely very important that they've taken them, but they're also a little bit disappointing if you put it into a historical context.
Well, congratulations on your presentation. Do you have any thoughts on the so-called super commodity cycle that could come when the world gets out of the COVID recession? I don't know if this has been incorporated in your Monte Carlo simulation because it gives you 98% probability of a sell.
Obi, can you please go to profitability, please?
Yes, sir.
We do expect the price of lithium to increase at a significant rate. We grow it at 14% over the first 5 years of our forecast, a 14% CAGR. The issue with Albemarle is that it's not going to realize a large benefit with these improving prices. If you look at the top chart on the top left of the slide, you can see the profit margins for Albemarle versus the industry. And if you notice during 2017 and 2018, this is whenever lithium prices hit their absolute peak. And the profit margins for the entire industry hit their peak as well. Albemarle's, however, remain stable. If you can go to the gross profit margin slide as well, please.
Absolutely.
In our forecast, we believe that the price of lithium is going to improve, and with it, so will Albemarle's profit margin to a degree. But the fact that 90% of its lithium unit volume is already contracted out for 2 to 5 years is going to limit the benefit that it receives from those improving prices because it has a fixed revenue structure.
Let me also add that there has been a lot of commentary in the commodity super cycle. And I believe it was at the end of 2020, there was a lot of hedge funds taking positions, betting on that. But since then, in the first quarter of 2021, those positions have actually reduced a little bit.
I have a hard time understanding. Well, thank you for the interesting presentation. So I do trade commodities as part of my portfolio, actually, and commodities. There's been a lot of underinvestment in commodities, and there with the growth picking up, and with the whole energy transition, there's certainly going to be kind of an appreciation that I expect. So I'm wondering help me understand why you think the firm is not able to capitalize on this, and why it can't mine more, for example. I understand some of the agreements are already in place, long-term agreements, but why can't it mine more? Why can't it benefit from a higher price? Can you go on, repeat that? I know you covered it, but I'm not quite sure I get
I'll start us off here. Was it? I believe this one. Yeah. So the company's ability to fund additional capacity is restricted by a financial covenant in its credit agreement, which restricts its debt to EBITDA to 3.5 after 2021. They're currently at about 4.0. And in their latest earnings, the management mentioned plans to reduce that debt to EBITDA level to pay off some of their debt. So the only other way, if they don't want to raise debt, the only other way they could raise money to build additional capacity beyond what we forecasted, which currently is already tripling. It's going from 85,000 metric tons to 225,000 metric tons by 2025. Despite that, the company still doesn't manage to reach the buy price. Additionally, as I mentioned, if they aren't able to raise money through debt, the only other way would be to reach out to the market, but that erodes shareholder value because of their ROIC and WACC components.
And when the price of lithium rises, we expect Albemarle to benefit from that. However, it has two other segments that will hurt its profitability relative to the other competitors, such as Livent, who rely more on the spot price and are a pure lithium competitor.
Obi, if you can go to G2 real quick.
And after supply and demand, and then I think we'll go to the next.
We do realize that this is a sensitive point in our forecast, so we stress test that. And we found that our sell recommendation wouldn't change unless the price of lithium would grow to approximately 40,000 tons by 2025. And to put that in perspective, it hit its peak in about 2018, around $19,000 per metric ton. And that was a price level that was just unsustainable for companies further down the supply chain.
The price that we have in our forecast is based off of supply and demand estimates that we got from other analysts in the industry or from companies in the industry. We used a demand CAGR of 43%, and that's higher than the estimates of Albemarle, Benchmark Minerals, Crew, and Roskill. They all had a CAGR of about 33%. And that ended up pushing our lithium spot price to around $14,000 per metric ton, which is also higher than the long-term estimates of Morningstar and UBS, excuse me.
Well, we have talked a lot about price, but let's talk about demand. Even if the company is not a pure lithium play, as you have exposed, valuation of companies like Tesla that imply a lot of growth for batteries in the future can be a major risk for your valuation and your assumptions. What are your thoughts on this? Because it seems that one company is pricing something and your company is not.
Can you go to EV to EBITDA multiples?
Yes, sir.
We're really looking over historicals. And back in 2019 and 2018, we had the exact same story. Analysts that were following Albemarle had the exact same story. And that was that they are positioned to capitalize on the growth in lithium that's inevitable with the coming EV boom. But there wasn't a massive change in the valuations of these companies until recently. It seems as though analysts have been following these retail investors that are just trading with such strong enthusiasm for this company, whenever really now we believe that it's being valued well above intrinsic value.
This is Simon. Just a follow-up question to this as well is that two of the theses that you have here base quite a fair bit in terms of the receptiveness of investors in believing that the balance sheet funding has a conflict with maximizing shareholders wealth, and as well as the lithium play that the company is claiming is not as what environmental friendly as what they claim to be. How would you sort of believe that these investor sentiments is not going to react in retrospective to this? Because it's not. I follow your thesis, but how are we going to bring this down to challenge investor sentiment?
That is a great question. Thank you very much. So one of the analysts that was following Albemarle had a strong buy. I believe their target price was somewhere in the 180s, maybe 170s. And they cited 2021 as the year of volumes. However, the company postponed some of their capacity expansion in 2020 because of the pandemic, and have recently reinvigorated that.
Thank you, Appalachian State University.
Thank you so much.
Thank you.
Thank you.